All right, let's talk about Markel Corporation. We're going to tear into their latest analyst report. You know how these things can be, just pages and pages of jargon and numbers. But our job today is to cut right through all that noise and find the real story they're telling.
And that really is the big question, isn't it? How do you look at a wall of data and actually see a narrative? Well, a financial report isn't just a spreadsheet. It's telling a story about where a company has been, where it is now, and where it might be headed. So we're going to follow the clues and piece together the story of Markel.
Okay, so every good story needs a main character. Before we get into all the drama of revenue and profits, we need to get to know who we're talking about. So who exactly is Markel Corporation? Understanding what they do is, well, chapter 1. Yeah, so Markel isn't the company you call for your basic car or home insurance. The source material calls them a specialty insurer. Think of it like this. They're the experts you go to for insuring the really tricky, unusual stuff. They operate in very specific, kind of quirky markets. And boom, this chart right here shows you exactly how they do it. You can see their business is spread out, right? You've got property, casualty, and liability, but look at that massive slice for other, 45%. That tells you just how varied and specialized they are. This isn't just a business model, it's a really smart way to manage risk.
All right, let's get to the first big plot point in our story. And thankfully, it's some good news. According to this report, it's all about the company's revenue, or what the pros call the top line. And the report is super clear about this. No beating around the bush. It says Markel's top line is trending positively. That just means more money is coming in the door, which, is always a good thing. But is there proof? And here it is. This chart lays it all out. Premiums earned. That's the bread and butter for an insurance company. And you can see that nice, steady climb from almost $8.3 billion in 2023 to a projected $8.7 billion in 2025. That's exactly the kind of upward trend you want to see. So what's fueling this growth? Well, the report breaks it down into 3 main things. First, their core insurance business is just doing really well. They're getting new customers and keeping the ones they have. Second, they're actually getting better rates, better prices for the insurance they sell. And third, they're making more money off their investments. It's kind of like a perfect storm of good news. Okay, but every great story needs some drama, some conflict. So after all that good news about revenue, the report throws in a little twist. While that top line looks fantastic, the bottom line, the actual profit, is feeling some heat. But here's where it gets really interesting. The analyst is careful with their words. They say the bottom line is currently under pressure, but then they immediately add that it ought to rebound in 2026. See that? They're basically saying, hey, there's a problem, but we think it's just a temporary thing, not a fatal flaw. So let's dig into that. What's causing the pressure? On one hand, you've got rising costs. Things like paying staff more and higher professional fees are definitely taking a bite. But, and this is a huge but, on the other hand, their main job, the actual business of pricing risk, is getting better. That improved combined ratio of 93% means for every dollar they bring in, they're only paying out 93 cents. That is a really, really healthy sign. Okay, so we've got this fascinating picture, right? Awesome revenue growth, but some short-term profit pressure. So, what's the final call? How does the analyst put it all together and give a verdict? First, we have the timeliness reading. It gets a 2, which means above average. What that's really saying is that the analyst expects the stock to do better than the overall market over the next year or so. It's a pretty optimistic, forward-looking statement. Then you've got the safety rating, also a solid 2. This one's all about financial strength and how stable the stock price has been historically. A good safety rating like this suggests it's a lower-risk kind of company, which makes perfect sense for a big, established insurance player. And whoa, check out this number. This is the one that really makes you sit up and pay attention. The report projects a potential high annual return of 19%. That shows that even with those cost issues right now, the analyst sees some serious long-term potential here. And if you want the whole verdict summed up in one sentence, the report gives us this one. Long-term price appreciation potential is compelling. I mean, the word compelling, that's a really strong choice. It's the analyst basically saying, yeah, we've looked at everything and we think this looks really good. All right, so we've been through the whole story, the good, the bad, and the final verdict. So what's the big picture? What's the one key takeaway you should walk away with from all this? Look, here's the whole story boiled down. Markel seems to be a really solid company that's just hitting a bit of turbulence. Their main business is growing like crazy, and they're getting better at their core job of underwriting. Yeah, costs are a problem right now, but the overall analyst verdict is still overwhelmingly positive. And here's one last little tidbit from the report that I find pretty fascinating. Even with that huge potential 19% return, the analyst says the stock might appeal to conservative investors. That's a really interesting combo, right? It speaks to that underlying financial strength and stability of the company. And so that brings it all back to you. We've taken apart the numbers, we found the story inside this report. A strong company dealing with some short-term issues, but with what the analyst calls a compelling future. They've laid it all out, but now it's your turn to decide what you think. Thanks for tuning in.